Good morning. My name is Brian Schubmel, and I am the Director of Major and Planned Giving here at Salem State University on our advancement team. Thank you so much on behalf of Salem State University and Salem State University Foundation for joining us today for what will be a truly informative hour. Now, it is my pleasure to introduce a true champion of Salem State, Joanne Riccadello, who hails from the esteemed classes of 1968 with an honorary degree later coming in 2019. Joanne and her husband, Phil, created the largest active alumni group outside of Salem. The Riccadellos have hosted alumni and friends in Southwest Florida for over a decade. The couple are members of our Crosby Society and Sullivan Society, including Salem State in their estate plans, furthering their commitment to students of Salem State University. The O'Keefe Sports Center complex is named in tribute of Joanne's late father, and the Riccadello Atrium, located inside the O'Keefe Sports Complex, is named in honor of Joanne and Phil. Last year, Joanne helped lead her class to the largest 50th reunion gift in Salem State's history. Now here she is to tell her story.
Hello, and welcome to another great webinar sponsored by Salem State University. I am Joanne O'Keefe Riccadello, a longtime graduate of Salem State College, and today a very proud member of the University Alumni and Foundation Board, currently serving as chair of the Fundraising and Engagement Committee. The Foundation Board, in simple terms, promotes and protects the funds that are so generously given to the university. Also, my husband and I are members of the Crosby Society through our legacy gift to Salem State a number of years ago. When Phil and I got married in 1969, we moved out of state. And fortunately, we reconnected with the university here in Naples, Florida, nearly 15 years ago. When we toured the university campus with then President Meservey, we were hooked. The life-changing opportunities for students provided by gifts like ours made our decision easy. It is really gratifying knowing that your final gesture of goodwill is enabling students to attend Salem State University, receive an outstanding education, and go on to successful careers in their chosen fields. I sincerely encourage you to visit the campus to understand how proud we are to be involved with the university. Now, it is my pleasure to introduce today's presenters. John Pastore graduated from Salem State University in 1994 with a degree in business. He stayed connected to his alma mater as president of the Salem State Foundation Board, the Salem State Alumni Association Board, and the Bertillon School of Business Advisory Board. John is a private wealth manager with over 20 years of experience, and he is a founding member of Integrated Financial Partners. Richard Austin is the Executive Director of Business Owner Solutions and Family Oriented Office. He serves as a national resource to integrated advisors and their clients. With over 20 years of industry experience, Rich consults with high net worth clients and business owners on estate planning, charitable planning, business succession planning, and tax planning strategies. I hope you will enjoy today's presentation.
Good morning, welcome. And thank you for the great introduction.
Yeah, thank you.
So I guess let's start. Again, it's always great to be back here at Salem State, and it's always a pleasure to be working with my partner, Richard Austin. It's a real treat. We know the great work, as Joanne mentioned. I've had affiliations with the Alumni Association as well as the foundation, and the work that's done there funds what I call the Dream Factory. So thank you all for spending time with us today. Hopefully, you'll get to meet someone that works in the financial services world. And if you're thinking about giving to this great institution, we're here to help. And hopefully you leave this hour a little bit more informed. A lot has been changing in the world lately. And we're just so excited to help demystify that, educate you on ways to be a better donor to the college, and answer any questions that you might have. Richard, we start the slide presentation? So if I could, the one piece that I would like to start to in my co-presenter, Richard, is that he's a unique blend, and you don't get this all the time, of qualified wealth advisor, tenured and credentialed, but also he has his JD and a very strong background in taxation. So as Joanne just mentioned, he's very unique for our industry, or any industry, that he can meld the three together. He just came back from a seminar not too long ago that was telling him about all these great changes that were coming down the pike, or maybe not so great, some of them. And, there's been a lot of change in the original plan, so we look forward to sharing that with you. When we talk about creating your legacy, when I started Integrated Partners, it was our goal to create a place that people could come in an independent manner. We're not tied to any insurance company. We're not tied to an investment company. What we're here to do is, in a holistic way, educate our clients on what their options are, fulfilling their life's great dreams, and ultimately creating a legacy that will live much longer at their time on earth, not only for their family, but for their community. And it's with great pleasure we get this event started. Let me start, Richard. You've worked with many families in this area. In your estimation, what are the barriers to getting started when you're thinking about gifting to an institution like Salem State?
Yeah, thanks, John, and good morning, everybody. So, financial planning, you would think that over time, when you spend some time, thinking about, it's a combination of tax laws, understanding your own financial situation, understanding your goals, whether those are family goals or charitable goals. It's complex, and and it just keeps on getting even more complex, with changing tax laws, and even if you decide like you want to, make a transfer and make a gift onto charity, what's the best way to do that? So John and I thought through. We wanted to give you a little bit of an update today on what was going on from a tax complexity standpoint. But we wanted to marry that to a process that we use with our clients around charitable planning. So we'll try today to combine those two together. And I know Brian and I think Brenna are going to be monitoring the chat room. So if there's any questions, if we can make this even, I know it's a small group, so we make it interactive. Love to kind of answer your questions and and make it personal to you. But basically, complexity is the changing tax laws, and then taking your goals, your family goals, and charitable goals, and understanding how do you make that gift, as impactful as possible.
Brian, and let me just jump in real quick. Brian and Brenna, is there a way that we can ask the group, the composure of the group? Is it more individual families that are thinking about giving to Salem State? Is it business owners that are thinking about exiting their business? Is there any way we could have people type into the chat room maybe a little bit about themselves?
Sure. Hi. If there's a comment, there should be a comment box underneath you. So if you'd like to do that, I'll monitor that and then I can report back.
That way we could kind of tailor our remarks today to your specific situation. I mean, we can also have some people that are new to business or younger in investing that are questioning, hey, how do should I be giving, or what's the best way, or how do I prepare? We'd love to certainly speak to the audience today.
So I know just from looking at our RSVP list, there's a lot of individuals in this. So I would start there maybe. And then I'll keep monitoring the chat throughout the presentation to make sure.
That's so helpful. Thank you, Brenna.
Thank you.
And Rich, why don't you start off with our good friend from Schoolhouse Rocks,
Yeah.
Mr.
I love
Ben.
this little guy, So, and I didn't put the music embedded into the PowerPoint today, but you all kind of remember the tune, how a bill becomes a law, right? And how he travels, up the steps of, Congress, and, has to make his way through the House and into the Senate and then signed by the president, right? We're going through that process right now. And this poor little guy, until about 2 weeks ago, I had a different version of this. This guy looks tired. So I had the little bill that was making his way. And, until like 2 weeks ago, we had, the fear that income tax rates, were going up. We were concerned that capital gains rates were about to double. We were concerned that, for those of you who have trusts that are grantor trusts, that those rules were all going to change and go away. On the estate tax side, that the estate tax exemptions were going to be reduced in half, and the sky was falling, right? And everyone, any CPA or accountant that, or attorney that you were talking to, they were just extremely busy. Then, and this was starting last December through guidance this past June into October 28th, they took it all away. They basically said, we're not going to increase your income tax rates, to 39.6%. We're not going to increase the capital gains rates, to 39.6% for, taxpayers that make over $1 million a year. We're not going to change the grantor trust rules, right? A grantor trust is basically a trust that you set up, if I could see all of you, I wish I could, because maybe you raise your hand or something, but you probably have a life insurance set of a trust. That's a grantor trust in essence. And there's other forms of grantor trust. And it's basically where it's taxed back to the grantor, you who set up the trust. And it's been a tried and true planning principle that John and I have used with clients like you for years. And so when Congress said that they were gonna, that's on the slate to be changed, everyone was like, well, what happens with our current life insurance policies that are in trust? How do we fund those trusts? It was mayhem, and everyone was making changes to their estate plans. Now we have a little bit of a reprieve. There's not going to be the reduction in the estate tax exemption, even though that'll sunset in 2025. And I'll go through like the numbers a little bit later on today, but so some of these changes that were put into place a couple of years ago were only put into place temporarily because, one of the things that happens when Congress passes, legislation, if they pass a provision that's going to be a reduction in revenue, unless they have offsetting revenue to offset that, it's temporary. So the increase in the estate tax exemption, from essentially, it's going to round the numbers from $6 million to $12 million, is temporary. It's going to sunset. It's going to go away in 2025. So you have a reprieve. And some of the other changes that were not happening for those of you that are specifically with business owners, you have, a deduction for, your LLC or your S corporations. It's called the Section 199A deduction, which is a 20% deduction. They talked about getting rid of that deduction, which is not happening. They talked about making changes to the 21% flat tax for C corporations and have a graduated schedule. That's not happening. And then the other one that they talked about, which was eliminating the step up in basis at death. So for example, for those of you who inherited, stocks, from your parents, if they passed away, or from other relatives, you received what's called a step up in basis, increase in tax basis when they passed away. So when you receive that $100 worth of AT&T or the $100 worth of AT&T stock, and your parents bought it at $1, it increased to $100 in value, which was great. So they were talking about taking that away, which would have been, I think it probably would have been just like, too hard to kind of like monitor all of that cost basis going forward. Like the one nice thing about the increase, there's actually two nice things about the increase in the tax basis when somebody passes away holding a capital asset. One, you have a cleanup of all the bases. Because how many times I know you've been in a situation where you're like, somebody doesn't have like the cost basis, on the stock. And so that becomes an issue. Nowadays with technology, it becomes a little easier. And then having the increase in tax basis from a tax standpoint, selling the asset, not having any gain, is a great benefit. So those are the things that are not happening.
And when they changed that, Richard, is it fair to say they changed this presentation quite a bit?
Yeah. So the gray in this beard now, I'm really kidding. So just I've updated this presentation a number of times. So.
The best one to share with everyone, and I have a little bit of information for you, Rich, because people have chatted in, is that Rich found out, we had one seminar that we were doing, and Rich is always a great sport, but he found out 30 minutes before the seminar that they were actually changing, they were going back and not making these changes that we were preparing for. So it was kind of fun to watch Rich do his magical dance. But I think the thrust of this is that there's a lot that you can do. And there's, really it's just, instead of it all happening at the end of the year, it still could happen. And good planning is just so necessary. And Rich, just to share with you, we did get some information. Some people put into the chat box that we have some retirees. We have some people that are kind of middle career, and we have some people that are new to their career too. So I know you like to tailor everything to the audience. That's who we're speaking to today, and we're so happy to be.
Great. And so just a little update too. So, I didn't get any updates like 30 minutes before this presentation as to, but so on Friday, the House passed the bipartisan infrastructure bill. So I think we kind of know, as long as that little bill guy is going to make his way through and Biden, signs that bill into law, we kind of know what's part of this package. But there were a lot of items that were crossed off. We just went through like a bunch of those items that would have been revenue generators, right? To fund social reform, infrastructure. And that being said, they might come back, at some point. But right now we have a little bit of reprieve on those, income, capital gains, estate items. On the next couple of slides, I have these in here for a reason, because I wanted to put something into perspective. So with our clients, and their attorneys and their CPAs, John and I have been working around the clock, getting trust put into place, modifying, plans, looking at clients, impact of potential tax law changes, and then they didn't happen. So when you step back and you look at it, you think about where are we now? Why does an increase in tax rates, motivate a client to take action? If there was a motivation there and tax rates are going to stay where they are for, let's say, a period of time, but like anything, it's not going to be permanent, right? We're at the lowest taxes that we've seen in years. And I wanted to, here on this slide is the income tax rates for a married taxpayer filing jointly. So when you look at, in 2017, you had the 39.6% bracket. That's what they were talking about bringing back in 2022. But where we are now, let's just say 2021, where we are now is the highest bracket is 37%. But what's interesting is, is the brackets before you get there. So you stay in the 24% income tax bracket, up to $329,000 of income in 2021, if we're married filing jointly. That's pretty good. I mean, you would have been in the 33% bracket in 2017. So that's a 9% swing, in tax rates, in the brackets. In 2022, where they were going to bring back the 39.6% bracket, they've always said, if you were making less than $400,000 a year generally, you weren't going to be impacted by the tax changes. And nothing that they put forward was making those changes. Where they were looking to make the changes was on taxpayers that were making more than $400,000 a year. And where they ended up was they put some provisions in there for business owners, with S corps and LLCs, and we'll talk a piece of that going forward. But where the biggest hit was the billionaires, and we'll just call it the billionaire taxes. I mean, they were probably hit the hardest. You see some articles out there about, Elon Musk, put out to Twitter, should I sell my Tesla stock? And he owns $200 billion worth of Tesla stock. Should he sell 10%? The polls seemed like they were trending saying yes. But it's a public company. It's $200 million. He doesn't take his salary. And if you look at tax, even though income tax rates I'm going to make a generalization for all of us might not be changing, for Elon Musk, it's changing possibly because they're putting that, an additional 5 plus 3, an additional 8% tax, on, clients that are making more than $10 million a year. So, he's got, for him, monopoly money or asking Twitter where they should sell the stock. In our world, we work together as a team where our financial advisors can make those decisions. So my point is, my point is that taxes are low, and where the brackets are and bracket management, if you could work with your financial advisory team to, make some good decisions, especially in year end, reallocating a portfolio or taking a low basis stock. And we'll talk later on about gifting over to charity, take advantage of some of the lower, if you have risks in your portfolio and you have a concentrated stock position, maybe taking advantage of some of those low tax rates and, looking at where your marginal tax bracket is. Capital gains rates. So a lot of you might not even be aware of this, and we have it ingrained in our head that long-term capital gains rates are 20%, right? Well, they changed, back in 2017-18, where capital gains rates went to 0%, which was there, at a I think like $80,000 a year income, but that 15% bracket for capital gains went up to around $500,000 of taxable income for married filing jointly. That's a 5% reduction about where you would have been. They were talking about changing the capital gains rate for clients making over $1 million a year to 39.6. For those, clients, or for those of you in that, tax bracket, that would have been, horrible. That would have been horrible for our business owner clients when they were going to sell their business. And they probably got a lot of pushback on that. And so that didn't happen. But where we are today, for many of us, maybe having access to the 15% capital gains rate as compared to 20, again, income tax rate, capital gains rate, they're the lowest they've been in years. Just a quick point on, the C-Corp rates, for those of you who are business owners who have a C corporation, they were talking about putting a graduated tax in there for C corporations. Tax rates used to be, prior to a couple of years ago, right now it's a 21% flat tax. And so it used to be higher than that. I forget exactly what the rate was, but it's lower than it has been in years. And for our business owner clients, setting up new entities, there's multiple reasons why they're setting up as a C corporation sometimes. And I won't go through all those details right now today, but entity selection is, when you look at taxes is one of the things that shifts a decision as to why one entity over the other.
So, Rich, that would really pertain to people that are opening a business, thinking about the long-term taxation of the business, looking at the changing landscape, and working with their accountant or financial advisor to select the best entity. Correct?
Exactly.
Good.
And sometimes it's the tax decision, but then there's also how the stock's going to be issued. Is it multiple classes that are allowed? Is someone voting or non-voting? So, but definitely taxes is part of the conversation. So when we look at historically, John and I put together this slide here just to kind of show you where the estate tax exemption has been, over the years. And this not sure why I started in 97, other than that's around the time when my financial career started right out of law school. So right there, when Rich was planning in 1997 with high net worth clients, the estate exemption was $600,000. A little bit over time, that grew to $11.7 million. That's a big swing. So what happens in the estate planning world, with clients back in 1997, you had a married couple, whose, net worth was higher than $1.2 million. You were doing a lot of planning, right? Fast forward to 2021, clients that are worth more than $23 million. From a federal standpoint, if they had their estate documents and their assets titled correctly, they didn't have an estate tax. So it really was a big swing and a change. But you can see in 2018 to 2021, that double of the exemption is only temporary. Because remember before I told you about the sunset? So that's gonna, Congress decided not to reduce it right now, back to $6 million. They're keeping it at 11.7 million. But without any congressional action, it's going to go back down to $6 million in 2025 anyways. So for a matter of 3 years, they probably just took that, with having pushback, they took that off the table. The red line there, what you can see is the tax rate, and the blue graph is the estate tax exemption. So you can see, again, we talked about ordinary income taxes being the lowest they've been in years, capital gains rates being the lowest they've been in years, taxes for a C corporation being the lowest they've been in years, and now the federal estate taxes at 40%, which, don't get me wrong, 40% is high, but it used to be 55% or even higher in some situations. So we're, have the lowest, tax rate, there that we've seen in years as well. I wanted to take a quick minute and just kind of talk about the gift and estate tax exemption. And for those of you who are in that, situation, a good situation where your net worths were like over $22 million, and we had quite a number of clients that were in that situation. The contemplation was, do you make a gift, over to a trust for the benefit of your family? And the way that the math worked was you had to, if you made a gift in 2021, you used the old exemption first. So in order for our clients to get a benefit of using the exemption, they had to make a gift essentially of like $6 million or more, because otherwise, if they reduce the exemption back in half from 11.7 million back down to 5.85 million, and they only made a gift of $5 million, well, then their exemption, the remaining exemption would have been $850,000 because you use your old exemption first. It was backwards math. It took me a little while to get my head around it. But it was, you had, at the end of the day, the rule of thumb was to make a gift of more than 6 million. So now instead of clients being forced to have to try to make these gifts by the year end, you've got a little bit of time because you have until it sunsets in 2025 to put those plans together correctly. And you still have one of our most popular, tried and true, planning vehicles available to you, which is a grantor trust. So being able to set up a grantor trust, make a gift over to that trust. The most widely used one is, you probably heard the term spousal lifetime access trust. So it's a trust where you basically set it up for the benefit of your spouse and your children. And so the grantor, let's just say Joe and Mary. Joe is the grantor, and he sets it up for Mary and the kids. And so Mary and the kids are beneficiaries of the trust. So Joe, transfers, $7 million over to the spousal lifetime access trust, but, and he gives up all control. It's off his personal balance sheet. It's not going to be, the growth in that trust is not going to be subject to estate taxes in the future. Great vehicle to use. And then Mary's a beneficiary of the trust. So at 5 years from now, 10 years from now, they need to access some principal from that trust. Mary's a beneficiary. Something happens to Joe, Mary's a beneficiary of that trust. There's other provisions that are in that type of trust, which provides flexibility. And it's a technique that's been used for decades, and the IRS was trying to get rid of it. So we still have it. So just, it's great because it's a great planning tool to use with clients in that situation. So I talked about what didn't happen, but what did happen? So the application of the net investment income tax to trader business. So basically what the IRS was trying to do was with S corporations and LLCs, where they weren't subject to the FICA taxes. If your business income, if you had, trader business income and it wasn't subject to the FICA tax, they're now applying the net investment income tax, the 3.8% tax to that income. There's some exceptions, to that, depending on how it's calculated between an S corp and an LLC. But they were trying to capture, predominantly it was the S corporations where the income that wasn't salary wasn't subject to the FICA taxes. The other thing that did happen was the limitation on 1202 gain exclusion. For those of you who set up entities and you set up a C corporation for your business from the beginning, you basically had the ability, you set up a business, you capitalized it, you grew it. 10 years later, it was worth $20 million. Well, the government said under code section 1202, you could exclude $10 million of that gain 100% from taxable income. That's a pretty cool situation. And that was one of the considerations for some of our clients who were setting up new businesses, where, and we have clients right now that are either in the tech industry or some cool new way to kind of live your life, like a new Uber Eats or something that's being set up. Maybe you choose a C corporation and you're one of the founding shareholders and you utilize that provision. Well, the change here, instead of getting 100% exclusion up to 10 million, you get 50%. So they reduced that, which is still not a bad deal. And then so I included this provision, the funding of the Internal Revenue Service. There's a lot of money that's being funded to the IRS for compliance. And so my guess, and my conversation with CPA professionals that we work with, we're going to see a lot more audits in the future. But that funding over to the IRS, for compliance, for tax returns, they're not allowed to use that funding to go after taxpayers lower than, I think, around $400,000 of taxable income. So for all of us that are below the $400,000, we're still kind of like safe. For all of us that are above $400,000 of taxable income, you're going to see over the next couple of years, heightened scrutiny from a tax compliance standpoint. So let the fund be in. So I made the point earlier about Elon Musk, exercising his stock option, for $20 billion, possibly at the end of this year or into next year. How many of us can relate, right? But, that high income, that surcharge, what did stick in this tax and the tax law changes was a 5% additional tax for taxpayers over $10 million of taxable income. And then for, taxpayers like over $25 million of taxable income, an additional 3%. So for Elon Musk's situation, exercising some stock this year, maybe it makes sense, to avoid that 8% additional tax. Forced liquidity, these provisions are, except for the last one, so the next one too applies to the mega wealthy as well, the one that's stuck. So if you have an IRA, larger, IRA, 401ks, the combination of qualified plans that's higher than $10 million, there's going to be a forced liquidation of a certain amount from those IRAs, to bring it down to a certain level, a certain amount each year. So besides the minimum distribution, the IRS is going to force additional amounts out of those large, IRA balances. And if your IRA balance is already at $10 million, you're going to, and your taxable income is at a certain level, you're going to be restricted from funding those IRAs for additional amounts. So those apply to the mega wealthy. Then for the rest of us, who live in high tax states, like myself, I'm in New York and John's in Massachusetts, and some of you might be in happy tax friendly like New Hampshire or somewhere else. I'm not sure, but we were reduced to, we couldn't take a deduction for the income and the real estate taxes in high tax states, and we're limited to $10,000 a year. So the proposal included an increase in the SALT deduction, up to $72,500, for married individuals, and so that's that's a pretty good increase from $10,000, $72,500. I'll take it.
That's a big one for anybody that lives on the coast, right, Rich?
What's that?
It's a big one for anybody that lives on the east or the west coast, right?
Yeah, definitely. So that's and they didn't bring back AMT. So sorry if I'm getting granular, but this is kind of fun, right? So
what's AMT, Rich?
So alternative minimum tax. So for those of you who filed your taxes in the past and you had when you kind of looked at it with your accountant, sometimes you'd have like that add back on, you'd see the alternative minimum tax come on like page 2 of the 1040. And it was because one of the items might be that your deductions for your income taxes or your real estate taxes were too high based on your income. And so they brought back some of it back in. Well, with the tax law changes and reducing the SALT deduction down to $10,000, they got rid of AMT. So a lot of us kind of ended up in a kind of similar situation. Now that we get the SALT deduction, and I don't think they brought back the AMT, I think a lot of us might be happy when we go to file our returns, next year. And
Rich, it sounds like you're giving us some good news here. For something that was supposed to be a big tax package, it sounds like for certain individuals, it might actually be a tax reduction.
It might be a happy holiday, yes. It might be. So tell our attendees, how do you get started with planning? Where do you start?
It's a good question, Rich. For some of you on this, and I know we have all different people at different phases of their lives, their financial lives. The first question is, how much can I give, right? So I think it starts with your own financial plan. So understanding your own budget, understanding your own situation, answering some questions. Am I on track for retirement? Am I on track for funding my children's college? Things like that. And that's something that a good financial advisor should be helping you with. So making sure that your money's working as hard as you are, and making sure that you have defined goals to move towards. And then really it's family governance. So once we have that in place, we start putting together the family legacy planning pyramid, which is, I've got my financial matters in place. Is my immediate family okay? And that could be a number of different tools from the toolbox. That could be a simple will if you're young and you're starting off, making sure that people that care about you have the ability to help you if you should be incapacitated, or if someone needs to make financial decisions or medical decisions, things like that. Filing a homestead. Also, who's going to take care of your children if you have them, if they're young children, if you aren't here. That's basic estate planning. Then you can kind of graduate up to more trust-based planning. And when we reach into the toolbox, that's really when we start to talk about trust, and Rich might go a little bit deeper on this later. That's what we call control from the grave. So we start with the basic idea of, am I okay? Are we okay? Husband, wife. Then is our family okay? If we go on that trip and we don't come back from it, do we have that estate plan in place? Dynasty, do we have it defined? We talk about the Sullivan Society. Do we name, in case there's a wipeout of the entire family, and we certainly, don't want to, it's very morbid to talk about, but hey, do we name our favorite charity in that? Or just in general, did we name our charity? Is that part of our overall giving plan? And lastly, it builds up to that, is my community okay? And then we start to think about places like Salem State, our churches, community groups that make a difference. Because the joke that Rich and I always say is they're not going to name the cafeteria at the IRS building after you. But you know what? If you make a meaningful contribution to to somewhere like Salem State, maybe you do have the naming rights, or maybe that something good is going to be done. A lot of people feel a little bit suffocated when they give money to the government. Are the things that I want to have happen? Hey, we all want to make sure there's roads to drive on, and we also want to make sure that the essentials are given to the people that need it the most. However, there's nowhere on our tax return that we can say, hey, I don't want this to go to bombs. I don't want this to go to, whatever it is that maybe you don't want it to go to. I don't want to be morbid or obscene. But anyway, at the same time, when you can define where that money is going, maybe you have a greater impact. The path to that charitable giving is understand what your charitable goals are. Talk as a family. Salem State, I call it my dream factory. Why is it a part of my plan? Because I wouldn't have what I have today if it wasn't for Salem State and what they've enabled me to do. Determine what to give. So then what's reasonable? And that's not a static number. As your net worth grows, certainly that could go up. As the tax changes go, we can make that, we can also fluctuate that. Decide when to give. So you might have highly appreciated stock, like Rick said. Hey, the market's at an all-time high. You can give that highly appreciated stock without having to pay capital gains, but getting the full credit for the donation that you're making, and how to give. So maybe you don't want to give all the money at once, but you want to create a foundation or a donor advised fund. Well, that's certainly something that we could do as well. We could talk about that a little bit more in depth. But they've made that so simple for us to set up as far as a donor advised fund, which is a fund that's run by great institutions. Fidelity has a fantastic program. And you can put your money in this year, get the deduction, and then give whenever you see fit or to your schedule.
Yeah, and you can really like utilize that, donor advised fund, and even calling it basically the Smith Family Fund, or like it really looks like a foundation, a private foundation, without all the complexity. And they really have come a long way. So just to kind of dive into each one of the steps a little bit more. So this is the process that John and I use with our clients that are, as we start to have the conversation around charitable planning. And some are charitably inclined and want to do well for charity, and well, everyone does, but there's different extents to what clients want to do. And some clients, really want to know about the income and estate tax, benefits of the charitable plan. And other clients are like, it's the charitable goals, and if there's the tax benefits that come from it, that's just, an additional benefit. So it's really balancing those goals, and for John and I, it's like understanding each one of you, our clients, and kind of bringing the right strategies to the table. But specifically this year, if you make a cash contribution to a charitable entity, you don't have any AGI limitations. Cash contributions can be deducted up to 100% of your adjusted gross income, which is a much higher increase than where it used to be. In addition, for those of you who are taking your distributions from your minimum distributions from the IRA, for some clients that are not itemizing or wouldn't itemize their tax return, sometimes giving a qualified charitable distribution directly from your IRA to charity, where that that $100,000 or some amount up to $100,000 would have been taxable as ordinary income if you took it out of there. It goes directly to charity and it's not taxed. That's a great benefit as well. And then when you look at determining, when to give, it's pretty much during your lifetime or death and putting a plan together. And it ties back into that financial plan, that process that John was talking about. And during your lifetime with, stock, let's say, for example, you might own, $100,000 worth of Tesla stock with a low basis, because let's be serious, it went up 175% this year. So if you had the good fortune of buying that, beforehand, maybe that's an asset that you gift over to charity, and get a deduction for it, and then satisfy your charitable goals, and and then maybe you can even repurchase it, after the fact, because it's not subject when you transfer something with a gain, it's not like transferring it not like selling it with a loss. You're not subject to any restrictions. So some examples of, charitable gifts, just to kind of repeat, cash, up to 100% of your AGI this year to charity. Low basis stock, great thing to consider. Oftentimes the easiest thing is just giving cash to charity, but if you got some low basis stocks, you've got a double tax benefit there. You get a deduction for it, and you're not paying the gain on the sale of that stock, especially if you're going to reallocate your portfolio or sell some of it. And then at death, a bequest to charity at death reduces down your taxable estate, so you don't pay any estate taxes on that. In my opinion, the best asset to go to a charity, coordinated with your estate plan, is making a charity a beneficiary of your qualified plans, your IRAs. And so because an IRA, at death is going to be subject to estate taxes if you have a taxable estate, but it's going to be subject to income taxes when your beneficiaries take it out. So you can have a significant reduction of somewhere between 30 and 65, 70% of that IRA account balance, right? So giving that to charity, there's no taxes. Charity receives it, the full amount. And if you coordinated that with a gifting plan and put some assets over into trust for the benefit of your family, maybe even used a life insurance policy to replace the asset that was going to charity, that's a strategy that clients have used, for years. It's tax efficient, and you've benefited your family, you reduced your estate taxes, and charity has been benefited by you as well. It's a win-win-win. And so it's a great strategy to consider. And determining how to give, John kind of started to kind of touch on this, but in the past where clients were giving direct gifts to charity, cash or your stocks is the easiest, right? But then sometimes clients still want to, maybe they have a big tax year and they want to get the tax deduction right away, but they want to keep a little control. They don't want all the money to go to specific charities right away. They want to, make those grants over a period of years and get their family involved, with that charitable entity. The choice there is a donor advised fund and a private foundation. I'm not going to go through the details of each one today, but a donor advised fund is a much easier, low-cost structure to accomplishing those charitable goals. If the charitable goals and the family entity structure becomes more complex, the private foundation is often considered. Two other strategies, charitable lead trust is great for getting a big, income tax deduction, having a lead interest go to charity and combining it with an estate planning type tool. A charitable remainder trust. This strategy is always been popular, especially when you have a situation where either bracket management or an asset with a lot of gain, and you've got to smooth out your tax years, and a charitable remainder trust will get you a little bit of a income tax charitable deduction, but you're able to smooth out that tax hit over a period of years. And so for the right clients in certain situations, with managing their taxable income, a charitable remainder trust is used to provide some benefit. And we've used it a number of times with our business owner clients, either managing if it fits appropriately in the sale of a business. So just a reminder, 4 easy steps that we follow through. It's establish those charitable goals, determine what to give, determine when to give, and determine how to give. And just, to take a moment, at this time is, just to kind of say thank you for all of you who are attending today. Thank you for all of you that support the charities that are most important to you, because it's important. And thanks for allowing, John and I to talk to you today.
So thanks, Rich. I think that Brian's going to be jumping back on, but in the meantime, if anybody has any questions, please feel free to reach out. And, you can either reach out to Brian in the giving office, or certainly, Rich and I are a resource to you if you would like some help in setting up gifting or planning around your gift.
No, yes, thank you both so much for all that terrific information. The relevance given the timeliness of the tax year, and also just how you approach your conversations with your clients is very much how we approach our conversations with our alumni and friends who are looking to support Salem State. So it really is, especially these conversations around such, it can be a morbid topic, right? End of life and planning, but I find them to be the most thoughtful conversations, and kind of getting to the most deep meaning of what people hope to accomplish through their legacy and what that means and looks like at Salem State, whether it's a scholarship, departmental support. But no, we approach it with that same approach. So thank you. We do have some questions that came in prior, but I encourage you, those who are with us today, to find a comment box and to add any questions you might have in the comments, and then we'll be able to pose those to John and Rich. One that came in that was interesting, and I appreciate it, which is the question of cryptocurrency and where does this fall in the world of financial planning, and whether or not it's something to pursue as an asset, and then also giving and just planning purposes. I thought that was an interesting question, so I'll pose that to you both.
Yeah, so just to make a quick comment on that type of asset, cryptocurrency, one of the changes that will apply is the changes to the wash sale rules, where if you have like a loss in an asset, you're restricted from buying it for I think it was 30 days. And cryptocurrency wasn't in that category. It didn't apply to it. But it's going to apply, they're changing that rule. It will apply to the wash sale rules. I can't make a recommendation or even talk about cryptocurrency to, it's whether you purchase it as part of your portfolio is something that should take into consideration from a financial standpoint, your overall, investment plan and tax strategies. So I think it's the whole holistic picture and figuring out what you do as a certain asset class or an asset sleeve in your portfolio.
Probably the best way to touch on that, because it's a unique one for a licensed financial advisor to touch on, because there are so many restrictions. But exactly to what Rich said, really understand what your core is, what your traditional investments are, making sure that you have a good plan with cash flow and emergency funds, and then have investments that are more speculative via satellite. And if you hit it big on your satellites, have a plan for distribution, and distribute those gains to Salem State. So anyway,
thank you for the hard sell there.
Talk about, but I just think it's really, everything comes back to the plan, and make sure that you don't overweight. There's a lot of things out there that have been, fantastic run up because the economy's been doing so well. You just don't want to be, I see a lot of youth overextended into certain areas. Just have to be wise about that.
Here's another one that came in. And this is coming from someone who's just getting into the estate planning. What's the easiest way to make a gift via an estate to support Salem State or another similar organization? I have some ideas on that, but
Brian, go ahead. You want to? Well, I'll give my point, and then Brian, you kind of jump in. I think it's kind of understand the big picture. So the beneficiaries of your estate, and the numbers, and then determine how much you want to give, to the charitable organization, and then what's the best asset to choose. Like I said before, I think, assets that are subject to estate tax and income tax, like an IRA, is a great asset to, go to a charitable organization. And that can be accomplished as easy as, a beneficiary designation of the IRA, rather than even changing your whole estate plan. And sometimes if you're using other assets, then it should be coordinated into your will and irrevocable trust, to make that happen. And then there's other advanced strategies that can be used to take advantage of low interest rates right now and combining them with charitable strategies that tie into your estate plan. So I think that was hopefully I answered your question.
No, that's great. I tend to go right to beneficiary designations, to be quite honest, because now with all of our access on the internet and access to our accounts, it's really a click of a button. You can go into your, whether it's Vanguard or Fidelity or whatever account it is, and simply add an individual or an organization. So it is, I think it's the kind of lowest bar of those, beyond even, a bequest. And we have all that language on our website. So if you're looking for just our general trust bequest, or excuse me, just our will and bequest information and how to list us, our tax ID, and for example, please feel free to see that at our gift planning site. And then, or just reach out for that conversation, because we're happy to talk and think this through with you.
One more thought on that too. I agree with Rich and Brian, both very good points. The concept that we like to think about when we are giving is for our donors to think about their taxable, their taxable estate. So things that are going to be heavily taxed at their demise versus their tax-free estate. And once you kind of break it down from there, and that's something that Rich and I do a lot, and if anybody's interested in that, we're happy to sit with you and help delineate between the two. But you want a gift out of your highly taxed, your highly taxed money, right? Your highly taxed estate, because you give it to your heirs, depending on their tax rate, they're going to be taxed at possibly a higher tax rate. If you give it directly to the school or to Salem State, it's a different tax situation. So your dollar goes further to your heirs, and it also goes further to your charitable institution.
No, that's terrific. And I see that we're running right to 11 here. And so just again, thank you, Joanne. Thank you, Rich and John. It is so appreciated. And these conversations are ones that are ever changing. And so we appreciate your willingness to now come back for a second year to kind of join us and think through these things as our tax landscape evolves. And my team is always willing to talk and to explore ideas, and to share any updates. And as Joanne suggested, visit campus and see what's happening here and the great work that Salem State continues to do for our students. So thank you all so much. And please be in touch.
Thank you. Be safe, everyone. Take care. Thanks for your time.